Well, joining me now from Tampa, Florida to discuss more is Rebecca Walser. She's the CEO of Walser Wealth Management. Rebecca, it's always great to see you. And for people who still haven't filed yet, what are your best tips?
Well, we expect 140 million filers this year, Kristen. So I think that the biggest thing that people don't realize, and especially investors that have been doing well on the stock market, obviously this year accepted so far, but if you have appreciated stock, you can actually make a direct donation of appreciated stock to your charity, and you actually get a double tax benefit because you can keep your cost basis that you had, completely avoiding all capital gains between your cost basis and the amount that you're, the value of the fair market value of the stock, and you get the entire fair market value as a write-off on your adjusted gross income, up to 30% of your adjusted gross income. So investors that have done well, that want to take some gains and some profits, especially during this volatility, could definitely look at that as a way to control taxes. But I think, Kristen, if they haven't filed yet, it's probably because they owe money and they're kind of fine.
Yes, I think that's a good point, Rebecca, because of course we know the earlier you file, if you are getting money back, you want that money to be earning interest. It's interesting for married couples, how much of a difference could filing on your own versus filing jointly make for some people's returns?
Yeah, and I just want to caution people, really, as a tax lawyer, I can tell you that the IRS, if you live in the same physical household and you do married filing separately, you're probably asking to be audited. That married filing separately is really for two people that are married that maintain two households. They live apart, they have jobs that are in different cities, they come back together, whatever. But literally married filing separately in the same household of the same address is usually a certain red flag to the IRS to say, audit me, I don't agree with what my spouse is doing. So please don't use that status unless you are living separately. Otherwise, you're asking for trouble.
Okay, good to know. Very good to know. What other funds do people need to factor in when it comes to filing taxes, and do retirement plans come into play here?
I think that, dollar cost averaging into your 401k is awesome, and people have been doing it for a long time. But really, Kristen, what we've seen is the rise of the Roth 401k that people do not realize their HR department is now even offering. And even though that's not as much of a tax deferment, we have really low taxes right now. In fact, the Congress is negotiating the extension of the 2017 Trump tax cuts that we got in Trump 1.0. So the fact is that right now might be a really great time to check with your HR department, see if you have a Roth 401k. Stop paying the taxes now and then build tax-free wealth in that 401k forever. The Roth 401k does have a 5-year original seasoning requirement based on Social Security number, so it's important to start that as sooner rather than later.
So you mentioned those 2017 tax cuts. They are set to expire, but of course we do anticipate an extension here. What more can you share on that front, Rebecca?
I think the biggest concern about the extension of the tax cut is that you have Republican lawmakers and even some Democrats that really want to see the SALT deduction, which stands for state and local taxes. And so that would be your local state income taxes and your local property taxes. States like California, New York are really, really high, and people did not like subsidizing that in the red states that don't have such a high tax burden. So Trump limited that in his first tax bill to $10,000. So if you had, property taxes of $30,000, you were only writing off on Schedule A $10,000, and that is what they're really negotiating now. A lot of people are wanting $100,000 per spouse or $200,000 exemption. That's never going to happen. So we're looking at maybe having it raised from $10,000 to $25,000, and I don't know if that's going to be per spouse or as a couple. So that's probably the biggest holdup right now of getting the tax cut extended.
And we know that you're a market expert as well, Rebecca, and given what we've seen in the markets of late, is there any impact or things that our viewers should be aware of when it comes to 401k and retirement funding?
The 401k is a pre-tax vehicle. So I would say that we would definitely be more impacted with the market route that we've seen on after tax and cost basis, because then you'd have realizable losses. But when you're looking at pre-tax vehicles, they don't have a cost basis because they have not yet been taxed. And so basically what happens is if you were to liquidate your 401k, when it was $1 million and then it goes down to $750, for example, you'd be paying taxes on $250,000 less. So the tax impact on losing investments inside of a 401k and IRA is that you will pay less taxes, but that's because your overall investments have gone down.
Rebecca Walser, great to hear from you. As always, Rebecca is the CEO of Walser Wealth Management.
Thank you.